Imagine waking up one morning and discovering that a currency you've held for years has suddenly become worth a life-changing amount. That thought grabs attention because it speaks to hope, frustration, and the human tendency to dream big when markets move. Today we're diving into one of the most talked about questions in niche currency circles. Can the Iraqi dinar or the Vietnamese dong ever increase 1,000 times in value? This isn't a short teaser or clickbait. It's a clear, step-by-step look at what would have to happen for a 1,000x shift to be even conceivable, and what realistic outcomes look like for holders. We'll separate emotional stories and viral rumors from structural factors, explain how central banks' liquidity and international recognition matter, and show why hope and reality often collide in dramatic ways. Stick with this breakdown if you want a calm. President Trump recently made his reforms the possible paths for meaningful appreciation and the kinds of reforms and events that could move markets without turning this into unfounded hype. To judge whether a thousand-fold increase is possible, we need to understand what 1,000 dose means in practical terms. A 1,000 dose increase in value relative to the US dollar would turn every $1,000 of dinar or dong into $1,000, a seismic change that would affect domestic prices, cross-border trade, and financial stability. For any sovereign currency, such a move would require not just higher nominal exchange rates but a wide range of parallel shifts: macroeconomic stability, clear fiscal plans, broad international acceptance, and functioning markets that can handle large volumes without collapsing. Central banks would need to manage monetary policy tightly. Banks would need adequate capital and liquidity, and international counterparties would need confidence that the currency is convertible and backed by reliable reserves or economic fundamentals. Moreover, redenomination or revaluation stories often ignore technical hurdles. Pricing systems, accounting records, debt contracts, and cross-border settlement systems would all require synchronized updates. When narratives claim a 1,000x move, they rarely acknowledge these operational realities. In other words, a 1,000x jump is not merely a headline, it would be a multi-year institutional transformation, and markets would expect to see coherent progress before accepting such a shift as credible. This section looks at the historical context for the Iraqi dinar and why so many people are emotionally invested in its future. For decades, the dinar has been a symbol of promise for holders who hoped political stabilization and oil revenue would translate into a stronger currency. After the fall of Saddam Hussein, Iraq rebuilt institutions, but political instability, conflict, and governance challenges slowed deep economic reform. A crucial fact about currencies is that value isn't just about national pride. It depends on measurable elements like GDP growth, sustainable fiscal policy, transparent central bank operations, and access to foreign exchange markets. The dinar's long period of low exchange rates reflects these structural realities. Many retail holders bought dinar notes at hobbyist marketplaces and online exchanges, hoping for a revaluation. Those hopes persist, driven by narratives that spotlight single events as triggers for a radical jump. In practice, markets reward predictability and liquidity. Sudden changes are rare because they create enormous winners and losers. To evaluate a 1,000x claim, we must assess whether Iraq's institutions and external trade relationships could realistically support such a transformation in a way that global markets would accept, and whether the operational work to implement such a change could be executed without causing systemic harm. Let's examine the central bank's role closely because it's central to any major currency move. Central banks control money supply, set reserve requirements, and manage foreign exchange operations. For a dramatic appreciation, the central bank must be credible and have a coherent strategy. That includes transparent communication with markets, credible foreign reserve management, and working policies to prevent runaway inflation after a change. Questions often asked by holders include whether the bank could decide to revalue the currency unilaterally and whether that decision would translate into market reality. Revaluation can be a policy decision, but without accompanying economic reforms and international market support, revaluation is largely symbolic. Global market participants watch institutions, data releases, and legal frameworks. If the central bank's policies clash with fiscal deficits or poor governance, markets will price in risk instead of responding with a massive appreciation. Hence, the bank's credibility and its relationship with fiscal authorities matter enormously. Market confidence is built on consistent data, audited reserves, and clear policy timelines. Absent those, even well-intentioned announcements will struggle to produce a real, sustained jump in exchange value. A major practical constraint is liquidity. Can holders convert vast sums of dinar or dong into dollars or other currencies at a much higher rate without collapsing the market? Liquidity depends on the number of market participants, depth of foreign exchange reserves, and access to international banking corridors. If a hypothetical 1000x revaluation were to be announced, there must be counterparties willing to buy the currency at those levels. Otherwise, the exchange rate will be meaningless outside a narrow domestic window. In many cases where currencies are thinly traded, local exchange rates diverge sharply from official rates because markets cannot handle large trades. That disconnect matters for retail holders because even if an official rate is set high, actual cash-out rates may be far lower once exchange costs and bank policies are applied. Building liquidity requires time, international relationships, and often changes to banking laws that allow easier access for foreign banks. Practical liquidity also comes down to settlement systems. If SWIFT corridors, correspondent banking arrangements, or payment rails are limited, converting large warm cash holdings into foreign currency becomes complex and constrained, limiting the ability of ordinary holders to realize theoretical paper gains. History offers instructive examples that help illuminate what's plausible. Think of redenominations and revaluations that did happen. They were generally paired with clear monetary reforms and internationally recognized steps. Countries that emerged from high inflation cycles often adopted tight monetary policies, sometimes backed by currency pegs or strong reserve positions, and then gradually allowed appreciation as fundamentals improved. By contrast, promised overnight windfalls rarely materialize. Major moves typically follow noticeable improvements in government finances, credible central bank actions, and tangible increases in export capacity or foreign investment. Even when revaluations occur, they are usually part of a package of reform measures designed to maintain stability and market confidence. Any claim of a 1000x one-off event should therefore be met with skepticism unless it is supported by a full set of institutional changes and market preparations. In short, history suggests that meaningful appreciation is possible, but the scale and timing are conditioned on systemic improvements rather than isolated announcements. Turning to Iraq specifically, the country has strengths and clear challenges. Iraq sits on large oil reserves which provide a potent source of foreign exchange if managed transparently and efficiently. Oil revenues, when channeled into responsible fiscal policy and investment, can underpin currency strength. However, years of conflict, governance issues, and political fragmentation have made full transparent management difficult. Banking sector reforms have been on the agenda, and international institutions have repeatedly urged regulatory improvements and greater transparency. For a dramatic appreciating move, Iraq would need to translate oil wealth into stable export earnings, build foreign reserve buffers, and strengthen monetary institutions. Absent those shifts, market forces and trading partners may be reluctant to accept a sudden huge revaluation. That is why many analysts treat significant appreciation as a long-term possibility, not a short-term miracle. The operational reality is that turning resource wealth into trustworthy currency strength requires both technical reforms and visible results over multiple fiscal cycles. Recent operational steps by banking authorities can move markets, but they don't automatically produce sudden massive jumps for retail holders. Regulatory moves, for example, clearer liquidity rules for banks or updated capital requirements, are important signs that a country is preparing its financial sector for wider market access. Those changes reduce technical barriers and increase confidence among domestic and foreign banks. but they are often slow to affect retail exchange outcomes because operational integration with international markets takes time. Financial reforms improve the architecture for a stronger currency, but the magnitude of appreciation depends on macroeconomic balances, external demand for the currency, and investor sentiment. In short, reforms are necessary but not sufficient for a 1000x jump. The market will look for sustained implementation, audited bank balance sheets, demonstrable reserve increases, and international banking partners moving to accept the currency, not just a single regulatory note or circular. Now let's look at the Vietnamese dong as a comparison because it helps to see how an emerging market currency behaves differently from a thinly traded one. Vietnam has seen steady economic growth, large export sectors, and increasing foreign direct investment. The dong's path has been characterized by gradual appreciation and managed exchange rate adjustments tied to policy and economic performance. Recent steps by policymakers to slow credit growth and cool asset bubbles show a central bank actively managing financial stability while supporting growth. When a country establishes predictable policy frameworks and a growing economy, its currency can strengthen over time. That means substantial appreciation is possible, but it tends to be incremental and linked to real economic progress, rather than a single abrupt multiplier event. For holders thinking in terms of multiples, the dong's likely trajectory is steady gains tied to structural reform, not a sudden 1000x leap overnight. The difference between a currency backed by expanding exports and one dependent on a single commodity is substantial when assessing plausibility. A 1000x claim also overlooks the global legal and technical issues that would follow. A sudden revaluation would force all domestic contracts, debts, and pricing to be redenominated or recalculated. That includes government debt, corporate contracts, bank balance sheets, payrolls, and retail pricing systems. The accounting work alone would be immense. Companies would have to update ERP systems. Banks would have to reprice loans and deposits, and cross-border agreements would need legal clarification. These changes require coordinated government guidance, legal frameworks, and practical timelines to prevent chaos. Is implemented poorly, a rapid revaluation could lead to legal disputes and liquidity squeezes. That risk is a major reason why policymakers favor phased approaches that allow systems to be updated in an orderly way and markets to adjust. Therefore, any narrative that promises instant riches from a currency jump should be tempered by the practical reality of system-wide disruption and the need for legal clarity. Consider the distributional implications: who gains and who loses in extreme appreciation. Large, sudden gains would mostly benefit those who can access liquidity windows and trade in large volumes, typically institutional actors. Retail holders often face limits such as bank caps, lengthy verification processes, and regulatory constraints that can reduce their net payout. In many historical cases, early access holders or privileged institutions captured most of the value, while ordinary savers faced hurdles turning paper notes into spendable foreign currency. Moreover, domestic prices for goods and services could change unpredictably if a currency dramatically appreciates, creating winners and losers across income groups. Policymakers must balance domestic price stability with exchange rate objectives to avoid social disruptions. This necessary balancing act makes a pure 1000x outcome less straightforward and highlights that significant currency shifts involve trade-offs, not guaranteed windfalls for all holders. The social and political fallout from mismanaged transitions is an important reason why most countries avoid abrupt, untested approaches. Let's put the dinar and dong side by side to compare practical prospects. The dinar's upside is tightly linked to Iraq's ability to convert oil revenue into stable foreign exchange and to improve governance so that markets trust the data and institutions. The dong's strength comes from sustained export performance, foreign investment, and institutional modernization that has moved Vietnam up the manufacturing value chain. Both countries could see meaningful currency strengthening over time, but the mechanisms differ. Vietnam shows how policy predictability and integration into global supply chains create steady appreciation. Iraq's path requires managing resource wealth and building confidence in public finances. Both are long-term processes that rely on credible institutions and market openness. A 1000x scenario would require both countries to experience extraordinary, synchronized shifts in fundamentals and global perception, a low-probability event compared with steady multi-year improvements that are far more realistic and actionable for holders. Economic reform packages are the sort of catalyst that could plausibly move markets substantially. But even these are rarely enough for a 1000x move. A strong reform package would include fiscal discipline, transparent oil or export revenue management, robust anti-corruption measures, and banking sector consolidation. It would also involve clear legal changes that allow foreign banks and investors to operate with confidence. For Vietnam, policy adjustments have included managing credit growth and addressing asset bubbles, which stabilize financial markets and reduce tail risks. For Iraq, international lenders and rating agencies often stress capital adequacy, liquidity rules, and governance improvements. All of these measures build the conditions for appreciation, but they typically deliver gradual market recognition rather than instantaneous multipliers. Markets prefer predictable progress and transparency, which is why most meaningful gains happen over months and years, not overnight. The timeline matters. Reforms implemented credibly over several quarters are the signal markets want to see. Another important player is foreign exchange reserves. Countries with plentiful reserves can support exchange rates, intervene to smooth volatility, and provide confidence to international counterparties. For dramatic appreciation, reserves play a role in signaling credibility and in providing the technical ability to manage large flows. However, reserves alone cannot create value without underlying economic performance. If reserves are used to artificially prop up a currency in the absence of structural reforms, the effect may be temporary and could backfire, leading to speculation and eventual corrections. So an effective strategy combines reserves with sound macroeconomic policy, structural reforms, and a credible path to convertibility, all of which take time. The point is that reserves are necessary for stability, but they are not a magic wand that can manufacture a 1000x revaluation on their own. They work best as part of consistent, predictable policy. International recognition and market access are non-negotiable. For any currency to trade at much higher values globally, foreign banks, brokerage firms, and international payment systems must accept it. That requires compliance with global banking standards, anti-money laundering rules, and clear settlement mechanisms. If a currency lacks trust on the global stage, counterparties will price in a risk premium or avoid it altogether. Building that trust involves years of institution building, regulatory alignment, and consistent economic data. It's also affected by geopolitics. Sanctions, regional tensions, or political unpredictability can deter foreign participants. So even practical reforms won't move markets unless partners see the currency as safe to hold and use in trade and finance. Without that acceptance, any high official rate would be a paper number with limited real-world meaning for holders trying to exchange their notes abroad, making a true 1000x practical outcome highly unlikely. Let's be candid about scams and misinformation because they complicate public understanding. The idea of a 1000x revaluation has long fueled online communities, speculative forums, and social media threads that often mix partial truths with wishful thinking. Unscrupulous actors sometimes market currency as an investment product without clarifying liquidity constraints or regulatory risks. This creates false hope and can lead people to hold currencies longer than advisable or to pay too much for physical notes. A responsible news channel has to call out these tactics. Speculation thrives when people are not given clear, practical information about how currency markets actually work. Be skeptical of anyone promising guaranteed windfalls or inside timelines. Real currency adjustments stem from policy and market realities, not private notifications or single-source tips. Protecting yourself starts with verifying claims against institutional announcements and understanding that credible change is documented, not whispered. If you own dinar or dong and want to prepare for reasonable outcomes, focus on pragmatic steps. Start by documenting what you own, serial numbers, where the notes were bought, and any receipts. Understand the official exchange channels in your country and whether there are legal caps or tax obligations when converting large sums. Consider diversification. Resting all your hopes on a single speculative outcome is risky. Look for reliable financial advice that is independent of currency selling interests, and consider waiting for confirmed institutional announcements if you plan to act. Keep records of communication with banks and authorities, and be wary of individuals who offer to guarantee conversion at inflated rates. Planning for a range of scenarios, from no change to moderate appreciation, will create a calmer, more controlled approach than expecting a miracle. Practical preparations protect you from scams and help you act efficiently if legitimate conversion windows arise. From a public policy perspective, governments must weigh benefits and risks when considering major currency adjustments. A sudden move that disproportionately benefits a small group could create political backlash. Instead, many policymakers design reforms to spread benefits through public investment, social programs, and measures that protect low-income households from disruption. In countries with large informal sectors, a key challenge is ensuring that policy changes don't harm people who rely on cash transactions. Transparent communication, phased implementation, and legal protections for contract fairness are essential to maintain social stability. This is another reason why policymakers prefer gradual, managed transitions instead of abrupt headline-grabbing events. Sound policymaking aims to preserve social cohesion while strengthening fundamentals, and that kind of careful approach rarely produces overnight windfalls. When we examine market signals, we look for consistent patterns rather than isolated headlines. For the dinar, indicators include exchange rate trends, central bank announcements about reserves or policy, and regulatory circulars that affect banking liquidity. For the dong, signals include export growth, credit trends, and central bank guidance on credit targets and financial stability. Watching these signals helps separate long-term improvement from short-lived noise. Investors and holders should understand that markets respond to a body of evidence. A single optimistic statement won't move a well-informed market as much as a sustained pattern of better data and credible policy moves. Tracking key metrics over time. Reserves, current account balances, credit growth, and audited fiscal reports offers a more reliable way to assess whether appreciation is likely and sustainable. What about extreme scenarios? A geopolitical shock that suddenly changes trade patterns or a major technological discovery that boosts one country's export earnings could theoretically alter currency values dramatically. Even so, for a 1000x increase, you would need an almost unimaginable set of events: immediate Iranian, massive new sources of demand for the currency, swift acceptance by international banking systems, and a legal and operational framework to process conversions at scale. In reality, such scenarios are either impossible or would still play out over a period long enough for markets to adjust in stages. That phased adjustment is the economy's way of maintaining some continuity and preventing systemic collapse. So while hypotheticals are interesting, they rarely translate into an instantaneous windfall for small holders. Meaningful moves generally follow observable economic shifts. Let's highlight a useful checklist you can use to evaluate any claim about dramatic currency gains. Ask, is the central bank credible and clear about policy? Is there a measurable increase in foreign reserves? Are banking reforms being implemented to handle large flows and protect depositors? Are international payment systems and counterparties ready to accept the currency? Are legal frameworks in place to restate contracts and debts? Are asset markets, like real estate, stable or overheating? Positive answers to several of these questions increase the plausibility of sustainable appreciation, but seldom do they add up to a 1000x outcome. Use this checklist to filter rumors from realistic plans. It will help you avoid emotional decisions based on partial claims and help you assess documented policy progress when it actually happens. We also need to talk about taxation and compliance because converting large sums can trigger tax reporting obligations and regulatory scrutiny. Some countries require declared conversions, and large transactions can attract audits or legal questions about the source of funds. This isn't meant to scare anyone. but it is a reminder that converting paper notes into spendable currency can be a formal, document-driven process. Keep proper records and seek tax guidance if you anticipate large conversions. Not only will this protect you legally, it will also smooth the conversion process and avoid surprises that reduce your net proceeds. Responsible planning includes understanding both domestic tax rules and any international reporting requirements that may apply if you move money across borders. Ignoring these practicalities can meaningfully reduce any potential gains.